Resurgent India Knowledge Series presents live webinar on Unlocking Wealth, Bonds versus FDs. What's right for you? Moderator Ms. Nidhi Vohara, Manager, Resurgent India Limited. Eminent speakers Mr. Gaurav Unyal, Head of Business Distribution, Bajaj Finance Limited. Mr. Aman Chauhan, Head Treasury, iFinance Limited. Mr. Damodar Mishra, Deputy General Manager, Gridco Provident Fund.
Nidhi, you can start.
Yeah. Can you display the PPT, please?
Sure.
Very welcome to each and everyone who has spared some of their time in this holiday to attend this webinar. Thank you so much. And a great welcome to Resurgent also giving me an opportunity to be a moderator in a webinar. And many thanks to the speakers, Gaurav sir, Aman sir, and Damodar sir for sparing time and joining this. Today, we are actually going to focus on bonds and FDs, since we are being witnessed of amid times like tariff wars, COVID, and interest rates. So, as an investor, where my sweet spot would spot, and then my safe haven would be there, if while keeping wealth creation in mind. So, where should we focus on? On this thing, we are keeping a webinar today. Hope this can help you a little bit in increasing your knowledge or giving you an insight of how to make a portfolio that can prove a safe haven and wealth creation both for you. Next. So today we are only going to focus on bonds and FDs. FDs which are being issued by only two people, that is, one is banks and one are corporates. Big corporates like Bajaj Finance, Shriram, and the others, they issue corporate FDs for their fundraising. And banks, they are being treated as a safe haven, a conservative approach, which is very much favorite of our all Indians. Each household will have an FD, I can say blindly. And if I talk about bonds, a diversified portfolio, diversified bouquet is there on the basis of issuers. We have PSU bonds, corporates, municipal. We all know NEFID has been given a good responsibility to promote municipal bonds also. On the basis of rating, we have a safe haven, AAA, and other rated instruments also, keeping their credit risk in mind. Next. Now, what we are going to see that how I am as an investor going to achieve the target of wealth creation. If I want to, of course, I should have some safe haven thing, some very conservative approach, which is being in our blood from our forefathers, that keep an FD. Why? Because one, it's a fixed rate, fixed tenure that we get. Tax safer option is there with 5 years of lock-in. I can actually claim some deductions also. I can get a loan over it, and basically I get a 5 lakh insurance as insured by DIC GC in India. But now we are done with the safe, but now I want the wealth creation also. For that, I need higher returns, better safety, and exit options, which actually gives me a option of capital gain. SEBI is being very much active in giving the OBBB platform to bonds market, a revolutionary thing, reducing the face value of the bonds from 1 lakh to 10,000 so that it can reach retailers. If we just understand the market trend in OBBB, 70% of the buyers are retailers and they opt for AA and A category bonds. What we learn out of it, that they are okay to take the credit risk, but they are not shying away from the returns. Why? Because in AA rated bond, you can target 9.5 to 10, but if you come a notch down, that is A, then you can target 11%. Now this includes SDIs also. So there you can actually beat the inflation, you can get the capital gain, others also, and many other exit options in the secondary market also. But now in the secondary market, you need a support of the broker or the merchant banker in order to sell your bonds. Next. Now, just a short comparison of what kind of bond returns I can target in different categories and what kind of returns I would be getting in fixed deposit. We are not saying that fixed deposit is bad or something. It is important. But yes, with the correct diversification, we can actually. But I think correct line of the observation, we can actually go forward with that. Next. Now, we have two instruments, fixed deposit and bonds. What kind of the risk that they inherit? Credit risk, very low in fixed deposits. Bonds, yes, they have credit risk. AAA bonds would be having the lowest as compared to BBB, AA, etc. Interest risk, fixed deposit don't have because they have a fixed amount of accrued interest that you would be getting there. In the bonds, yes, they have an inverse relationship with respect to the interest rates. Liquidity, very moderate, only a small penalty that a investor would have to pay if they withdraw the money before its maturity. But in bonds, yes, liquidity risk is there. If you invest in a low liquidity bond, then getting out of it is a little bit difficult as compared to AAA rated bond. So liquidity concerns are there where the SEBI is also working hard. Market risk, not much in FD, but in bonds, they are being there because it is being market trend, market related, especially in secondary market. Inflation, if we come to the real returns that an FD get, we sometimes get a negative returns. But in bonds, yes, we can beat the inflation with the correct diversification. Default very low in FD. Since RBI is very active with the banks, they can actually do the PCA, that is prompt corrective actions with them, so that retailers or depositors do not get harmed. But bonds, yes, we have seen much cases like DHFL and others. Next. Same we have tried to show with a comparison of an FD, which is very safe, with the most safe bonds in the market, that is AAA rated. Now, yes, you can get most of the benefits that an FD give, but a better return. Next. Now, what the regulatory is doing in both the instruments. As we are right now here, in FDs, we have basic things. Senior citizen would get better returns than the normal one. 5 lakh insurance for your FDs would be there. The best thing is you can get your FDs via online without any hindrances or printing or going to a bank thing. But in bonds, you have a huge reforms going on, starting from the SEBI OBBB platforms. Mostly 27 platforms are still there. They are getting huge response from the retailers. Now, if we talk about the big issues, electronic bidding platforms, where it actually gives a benefit of uniform bidding and uniform cut rate, at what rate the allotment would be done to the investors, especially talking about the institutional investors. Now, the lower denomination bond, that is specifically for the retailers. Now, with the minimum value of 10,000, they can do it. A strictened rules for the credit rating agencies, so that what mistakes they have done in previous, they cannot repeat in future. Next. Tax implications. First thing, when you actually invest in any of the instrument, you should be very much aware what kind of tax they have. So in FDs, there's no capital gain, but yes, you can actually get a tax saving FD for that. But in bonds, you can actually get a tax benefit via the bonds or through the bonds also. For example, you sold any immovable property and you get some return out of it. So if you invest in some of the bonds issued by and permitted by the central government, so you can claim its exemptions in the section 54 EC. Those bonds would be NHAI, PFC, REC, IRFC, and others. Next. Now, what's the scope that bonds and FD have in the next 5 years? FDs, obviously, it's a capital preservation tool. It's not going anywhere. We should have a little portfolio portion in it, and they have tested the test of time where they even in the COVID, tariff wars, any other thing, they have been with us and as a safe cushion. But in bonds, since we India is being included in the JP Morgan index, also have been able to reach $7 to $8 trillion by 2032, and corporate bond section has actually surpassed the growth rate of the market, that is 6.5, and they have given 9%. And SEBI himself also predicts that yes, with the retail participation we would be able to grow at 5 to 8x. A well diversified portfolio can prove to be a better heaven for the investors to look at it and create their wealth over it. And we all know all the institutional investors are being majorly invested in bonds, not in anywhere else. Even in the different amid this equity thing where the lot of outflows are there, bond market is staying strong. Now, this was all about the PPT and the basic knowledge that we are going to this. Now, quickly moving forward for some of the questions that we have and the audience have for our speakers. We'll start with Aman sir. So for you, the question would be, with rising interest rate and volatility, where do you suggest investors should focus on, bonds or FD, for both the terms, that is long and short?
No, so correct me if I'm wrong. You said there is a volatility. Yeah, there is a volatility in the equity market, and the interest rate prices are now coming down, right? You're on.
Yeah,
Yes.
yeah. So just a situation, sir. For example, now there's the tariff war has given, and we have seen that the huge slump was there in the US yields also. So on those situations or the COVID situation, what an investor should do so that, like, we are a part of the financial ecosystem, but a basic human investor, they are not very much aware with all the terms. So where he should look for?
So right, there are two different markets which you're talking about. One is the equity market, and another one is the debt capital market. When you think of all what is happening in the market, all the news that's been around in our newspaper is because of the changes or up and down in our equity market, mostly driven by what is happening in US market, and all those changes in tariff and everything is making all the other countries a bit nervous, and so the equity market are responding to those nervousness and uncertainty in future. So that's been the case, and if you see for last 4 or 5 years, the equity market, at least in India, have been giving pretty good returns, and for that matter, for US also, it's been doing fairly decently in last 4 or 5 years. But because of the changes and what the overall economies are going through, this correction in the market was long due. And over the period, what people will start observing is that the correction will continue for some more time. And as we go ahead, people need to take care of what value they can preserve of their investments. People would have taken a good amount of hit in their portfolio if they have been investing in last 1 or 2 years. And last 2 or 3 years, there was a huge noise from the market, also from the bankers and finance minister also, that people are investing their money, drawing down on their fixed deposit, investing in the capital markets or equity markets. And at the same time, the capital markets were not that preferable at that point of time, because people were getting good returns in the equity market. And as we see, the capital is now moving away from equity market to gold or to bond markets, and that is one trend that will continue. That's why you see the gold prices are going up. And what opportunities are coming up, this what bond market or FDs, they will always be a safe haven for the investors. People have been getting a sense of people always have access to FDs from banks, but bond market, which is like not that developed in India, but what SEBI is doing for last 2 or 3 years, they have been coming up with different regulations, which basically helps in enlarging the overall market environment, giving giving licenses to OPP platform where people can invest, lowering the ticket size on the bond, with coming up with a 10,000 investors can invest up to 10,000 as a per ticket size, which opens up a retail market for many of the borrowers, and they can invest in. As what you mentioned in your introductory slide, the returns are pretty good. You can get a decent return from 8% to 13%, depending on your risk appetite. So at this point of time, what I think people should be thinking about other investment avenues as compared to equity market, because equity market will be in it will take some time for equity market to stabilize.
Sure. So, can we like summarize that having some of the your exposure to both FD and bonds would be good for?
Yes, people should explore FD and bonds, as well as what they have been doing with equity. Equity has been good, but now they should also focus on FDs and bonds, depending on the risk appetite.
Okay. Let's move to the next question I have for Gaurav sir. That is, sir, with the inflation increasing, do you think investing in any inflation-linked bond or any AA or A-rated bond would be a better alternative than FD, since we are able to beat inflation there and they're giving pretty much good returns?
So as a NBFC and as a B2B dominated organization, we are more talking to the partners on the field, and we are very close to the partner franchise who are financial advisors and primarily talking to customers and speaking to them. So what hunch and what understanding we have got from them, they feel for next 6 months or 9 months, FD remains a very strategic and very safer side to invest, because they feel the way banks are operating, the way repo rates are moving downwards, it is for granted that rate will drop further and there will be volatility in the market. So it's better to be in a safer side as an investor. So their recommendation in the market, that this deposit market is primarily driven by partners. From them, the recommendation is deposits only, because they are not very sure whether they will be able to give those kind of returns to the customer which they have committed to them. They don't want to spoil their relationship as well. So which I also feel is a safer way to do it. And they have a bigger understanding as they operate with the bank as well. They study industries, international markets too. So for them, FD remains a safer side, and they normally give first preference to fixed deposits rather than going towards the bond to the customer as if now.
Okay, we still have a lot of interest in FD going on the grounds one. So, Damodar sir, can you hear us now? Okay, we have next question for Aman sir. Sir, what should be in the event of any credit degrade from or of the bond issuer? What should be an investor plan for its exposure and exit strategy?
Yeah, so as people have less experience in dealing with bonds, so what typically term sheet reads out in a bond instrument is that at the event when there is a rating downgrade or some default happens, and in the issuer who have issued this bond, there are typically 2 or 3 exit options that are available for an investor. So as a part of term sheet, you will typically find, in case there is any breach of any of the covenant, first and foremost option that an investor gets is they can get some additional default interest from maybe going as low as from 25 bips to 2%. So that till the time there is a default continuing or there is a breach of covenant that is continuing, the investor will get that. Another option that is built and this is a default option. And if if the investor he doesn't want to continue with the company, and if he sees that the risk is not as per his liking, so he can get he also gets an option to redeem his investment. He can reach out to the trustee and can ask the investor to redeem his investment. If those enabling covenants are there and as a part of the loan documentation, so that option is also available. And in the so these are the two options he can pull back, because to reach out to any other consequential what do you call solution for the investor, you need to have a majority consent. So on individual basis, the customer has two options. If he thinks that the company is okay that he has chosen, and the what do you call the breach of covenant is momentarily, and it can the company will do good in future, so they can continue, can earn a little bit extra interest. And if he thinks that the company he doesn't have faith in the management of the company, then he can ask trustee to reach out to the to the issuer and can redeem his investments.
Quite good point, sir has highlighted, to always see who is the trustee and what should be your exit strategy in the event any mishappening comes. So thanks for this. Gaurav sir, we have next question for you. Since we see that most of the corporate bonds and yield are surpassing the FD returns, so do you see any institutional investment behavior shift when you talk on the ground, talk to the big investors? So do you see their viewpoint towards FD is reducing or not? Like how they going on?
So the way corporates have responded in last couple of weeks or so, the response has been more than excellent, I should say. In terms of deposit, their inclination has been huge. They are more keen to invest in FDs. They want to secure their returns for as if now. They don't want to play around these changes in the market and the way this industry and the way banks are operating. They don't want to take risk, and there are the big corporates and huge amount involved. For them, these capital gains matters a lot. So we have got a lot of offerings from I can say about my organization per se. We are getting a lot of offerings from these big corporates. They want to put into FDs for a shorter terms, primarily for 12 months or so, because they see FD as a more secured and stable return for now. Because on rest of the things, bonds and others investment, they don't foresee any consistency. And of course, FD gives them a flexibility to premature. It helps them to remain constant in their liquidity funds as well. They can always take this out and put it somewhere else. So there is a huge shift and positive shift in corporate deposits for us. We have actually got multipliers in that
Okay,
in last couple of weeks.
sure. So, Aman sir, let's take 1-2 questions from the audience also. He's asking that as a gold price is increasing, and you mentioned in the first answer you gave that gold bond is a good option or not?
Yeah, gold bond is gold bonds are a good option, but I think the sovereign bond scheme is not being continued by the government. So, but you can, so yeah, so as an option, it's not available that easily. It was available earlier. You can always go and purchase it in the secondary market, or primary issuance. I don't think, at least for now, government is not planning.
Sure. Damodar sir has joined us again. Sir, are we audible? And okay. So next question for Gaurav sir would be, so the new reforms which is coming by the SEBI per saying their reduction of the face value or OBVP, do you think that there's a growth in the market and retail participation for the bonds along with the FDs? Don't worry.
Yes. There is a quite increase and there is a quite acceptability which we can see. We can see that the acceptance has been quite high and it has been a 360-degree shift since this change has happened. There is lot of queries coming in and partners also wants to learn things. Raise lot of queries around it, and I see it's a very positive shift. Retail will for sure move to decent growth in coming months because this acceptance seems to be very high as banks have already shown their positiveness towards it.
Correct. Correct. So, Aman sir, what parameters that a person should consider before investing in FD and bonds, and where you find your attractiveness?
So see, so first of all, there are multiple factors. Like in FD, it's a no-brainer. So you have different kind of institution offering FDs, going from PSU banks to private banks to NBFCs. Each one have their own strength. If you are going with the bank, then it's a no-brainer. Everybody knows usually the strength of banks. They are backed by government, and there is a specific guarantee of up to 5 lakh rupees that safeguard their investments. For NBFCs, bigger NBFCs like Bajaj or like Mahindra, they have a good parental package. So that is also a very good safe option. In terms of bonds, there are multiple things that are happening currently in corporate bond markets. So bonds are being issued by big corporate houses. So like Bajaj, for that matter, there are many AAA rated company who are floating their bonds to fuel their debt requirement. So you at least you should be aware when you are selecting a company in bond market, depending on your risk appetite. If you want to earn little extra, so you can go you can go to AA or single A rated
Correct.
entities. You can move to you can check what is their backing, how much capital base they have, are they, and what is the business model that they are basically opting for, and what kind of profitability they have been able to manage over a couple of years. For a layman, if they want to start investing with the company who have a good credit rating for last 2 or 3 years. AA or single A rated is a fairly decent rating exercise. You and if you go by some of the data that we have in public domain, the default percentages on a single rated entity is as low as 0.01. So
Correct.
there is very low default risk in these instruments. So you can base your investment option based on the rating also. If you don't have too much of time to go into studying each and every instrument or a company that is out there.
Dominance and all.
Yeah. So that is one thing, and another thing is that whenever you are investing, also go through the term sheet or information memorandum, which is a part of the loan issuance or the debt issuance. That will give you some idea that what are your rights as an investor and what you can do in case, as there was a question earlier, if they want to get an exit option, what all exit options are there for an investor. So these all things you can, when you start investing, you will be able to read through all these things, and you'll be in a safer position.
Sure. So, Gaurav sir, next question is for you. Like, can you help and demystify the perception that FD are risk-free and bonds inherently carry risk? Because we all know that even if you get a 100 CR type of FD, banks give insurance for 5 lakh, and the rest moves. Similarly, with our lockers also, the amount, the material that we keep in it, they are not insured. So similarly, same question to you, that perception that FDs are very risk free and bonds carry risk. So can you help us with that statement?
So whether I should support this statement or not, that's a different thing. But I think that's a valid statement as well, because as you see, FD being a conservative approach of investment for so many years. So people or banks or even corporates, they opt for this option for longer run, and bonds offer a high risk, high return option for everyone to invest. So we must not say that it's not a safer option just because FD offers some insurance and it's become a more safer option. Uh, Bonds are equally good in terms of if somebody wants to create portfolios of what they, as you asked the right question, what percentage investment investor should think about. For right now, the kind of scenario the market has, I think 40-60 ratio in favor of FD should be the right approach. Both the options are secured ones, irrespective of insurance offering from FD or the not. And bonds still remain a high earning opportunity and high return opportunity for everyone to evaluate.
Sure. My question to Damodar sir is, what's the investor point of view? From the investor point of view, what's the scope of bonds and FD that you see in next 3 years? You can answer while keeping the video down, sir. I think there's some connection error. So same question to Aman sir. From the investor point of view, that what is the scope for FD and bonds in next 3 years?
So see, from investor's point of view, I'll say that FD. So FD is a no-brainer. FD has been there from starting. What is happening in the market is that there has been a lot of push from SEBI to develop the corporate bond market. And in recent past, because see, if you compare our debt market with our corporate debt market to the developed nation, it is very, very low. And the kind of growth that we are looking for the country, banks cannot fund the entire growth from their balance sheet. So the retail participation through the debt market is something that our SEBI has been trying to achieve. And for that, they are providing different investment option to the investors. In coming future, as we go along, as the economy develops, the bond market will also see exponential growth in next 5 years or so, because there has been a lot of regulations. So there are regulations from SEBI that bigger NBFCs, which are like more than 5,000 crores or more than 5,000, should be at least getting 25% of their funding from capital debt market. Why they are doing it? They are trying to, first of all, diversify the risk across different market participants, and capital market is one of them. And also, they know that government know that entire growth cannot come from PSU bank or for private bank for that matter. If you kind of growth we are seeing, the balance sheet will not grow at the same pace at the same pace at what India is growing. So that diversification of risk and also an alternate source of funding is something that will see a future, and it will grow. The debt market will grow, corporate debt market will grow.
Surely. Let's take a question from the audience. We have quite a bunch here. So Manoj wants to know that what is the indexation benefits that a bond offer? Or do bond have any indexation benefit or not? Aman sir?
Sorry, I will have limited comment on that. Sorry.
Okay, sure. Nick, last question for this is that bond is a good option for a salary income person over FD?
Yeah. So see, we have, as an institution at iFinance, we have been doing bond issuance of more than 500-600 crores in last 12 or 13 months. And we have seen a good participation from many of the investors, different class of investors, right from HNIs, as right from institution to HNIs to retail investors. And we have seen even our own employees investing. We have seen people from different domain all along asking for how can they invest in it. So people have been getting, I've been getting a lot of interest in this, and not only salaried people. So for salaried people, it's a very good option if they understand it and if they know the risk associated with it. So it's a very good option.
Surely. So last question for the evening would be to you, like being a treasury manager and advantages that a bond versus FD, if you just crisp it in a way for an NBFC and for the normal investor.
Right. So see, from the treasury point of view, if I have to say, we started this issuance of NCD like 2 years back, and we have received very good response from all different class of investors, and it gives you a flexibility to go out to the market and tap the market as and when you require, and because the other funding channels like banks or other bigger institution, they take time to basically come to you and disperse the fund. You can basically strategize your funding through different channels, and having an accessibility to capital market is a very good option because it gives you that flexibility when to tap the market, when do you want to go to the market, and also as there are different class of investors, you can have a different approach to each one of them. And we have received a very good feedback from all the segments. So for any NBFC, they should explore it.
Surely. So that's all from today. Thank you so much, Aman sir, Gaurav and Damodar sir for joining, and our researching team. Thank you so much. Have a lovely day and giving us time for on this holiday. Thank you so much.
Thank you.
Yeah.